Indices on Wall Street closed mixed. The S&P 500 closed 0.5% higher on the back of a soft inflation report as CPI increased 0.2% for the month. Meanwhile, Nasdaq jumped more than 1% as traders snapped the tech shares. Stocks in Asia trade mixed. Following cues from Wall Street, the GIFT Nifty is indicating a higher start for the Indian market. Oil prices rise at 2% on the back of weaker dollar even as tariff uncertainties loom. Brent trades at $70 a barrel. Gold prices rise aided by cooler U.S. inflation report. Retail inflation in India eases to a 7-month low in February, mainly due to a fall in food prices. This eases the way for RBI repo rate cut next month. Industrial output grows by 5% January on the back of uptick in manufacturing activity. Hello, good morning. You've tuned into CNBC TV 18. You're watching Power Breakfast with me, Mini Motiwala. Thank you so much for tuning in. A quick look at what the Asian markets are doing today, and bit of a mixed opening is what we could say coming in for the Asian markets. Like you can see, Taiwan index holding on to gains of almost 0.5%. On the flip side, you have Hang Seng that is down 0.3%. Shanghai very muted is what has opened up in trade as of now, 0.07% downtick, so bit of a negative bias, but not a sharp fall that we're seeing. On the other hand, like I was saying, it's mixed. Why? Because you're looking at Nikkei, which is holding on to strong gains of almost 0.7 to 0.8% in the trading session. ASX 200 very muted in today's trading session. So muted, negative bias for some of them, while the others are managing to hold on to green. Let's pull up the Nifty implied open and see where that is moving on. Right now, 31 points uptick is what is indicated. So at least some bit of a green is what we could expect on the screen coming in today. Let's watch out for where that is going to be headed. But as of now, a bit of a muted to a slight bit of a positive start is what we are expecting for the Indian markets. But yes, that's the roundup that we have coming in from the Asian markets. But looking at the cues from the US markets, where we saw that Wall Street ended higher overnight, and this is after a soft inflation report that was eased concerns about the economy as investors snapped up, beaten up technology shares. I beg your pardon. On the back of that, Nasdaq gained over 1.2%, while S&P 500 gained 0.49%, with Dow Jones ending marginally lower, down by 0.2%. The tech stocks, such as Nvidia, AMD, jumped up to 6% in trade, while Tesla shares rallied 7% overnight. To get a wrap up of the US CPI data that came last evening, Rick Santelli is joining with us to give us more updates on that one.
Our February read, consumer price index expected up 0.3, comes in a tenth light, up 0.2%, and in the rearview mirror, at least now, not revised, and up 0.5%, by the way, was a 2-year high we're reversing from. Up 0.2 equals where we were in October. To find a lower number, you're back to July of last year. Strip out the important food and energy, it remains up 0.2 on core. That's following up 0.4, which was the highest level since Feb of 23. 0.2, what we equaled Dec of last year. Find a lower number, you're in June of last year. Year over year, headline number, 2.9 expected, 2.8 is what we get. Last look was 3%. 2.8 to find a lower number. You're in November of last year when it was 2.7. And do remember that cycle at the end of last year, we actually saw 2.4 on the September read, just to put a face on the fact that we have been lower. And if you look at ex food and energy or core year over year, 3.1. 3.2 was what we were expecting. 3.3 in the rearview mirror. 3.3 in the rearview mirror was the highest since May of last year. 3.1, to find a smaller number, you have to really go into the Wayback Machine. You're going to April of 21 when it was 3%. Now, I know many don't look at the following, but if you look at the actual index of CPI, that goes back to 1913. Right now, we have 319.082. That's another all-time high going back to 1913. If you look at core, that was started in 1957. It comes in at 325.47. And guess what? Another new all-time forever high. Go use that inflation tool on the Bureau of Labor Statistics and the website, and what you'll find is inflation's running over 20% on a compounded basis going back to pre-COVID. Interest rates initially moved lower as they looked at the month-over-month numbers. You know that parlor game, you analyze these numbers, but in the end, they're still sticky. And just to point out something, our last look, still unrevised, these inflation numbers were hot last time, unlike today where they're a bit cooler. And what happened? We settled on February 12th, the last time January CPI was out, at 463 in a 10-year. It was the high water mark. Hot inflation, all we've done since is go lower. And the reason I point that out is there's a lot of moving parts pushing yields around these days.
Well, after a softer US CPI print, how will the Fed move now, and does the inflation align with Fed's target? Listen into what Subhadra Rajappa of the Society General had to say on this front.
Look beneath the hood, you get a very different picture. I mean, you look at a broad variety of metrics. I mean, airfares went down, but you saw things like used car prices start to go up. You've seen other categories within the CPI basket, recreation, apparel, all of that went up. So you kind of have this haves and have-not story, if you will. Where, although the headline was, lower than expected, point to headline and core, overall, I thought that some of these underlying, parts of the basket showed, that inflation was still quite sticky. I would argue that the bond market is actually looking at, somewhat of a softer CPI print, but looking past that and saying, you know what, we haven't really seen the impact of tariffs yet. So once we start seeing the impact of tariffs, that would mean higher inflation prints and a Fed that's going to be on pause for a lot longer. That's part of the reason why you saw the market start to, price out cuts that were priced in ahead of the CPI print.
Okay, now let's get you the final update of our global market wrap this morning. Markets in Europe ended Wednesday's trading session higher despite US and European Union tariff escalations as Ukraine's peace hopes lift sentiment. Now, the French CAC adds around 47 points, while the German DAX added a whopping 347 points. The FTSE that ended 45 points higher in trade as well. When you're looking at it, the regional stock 600 index that closed 0.8% higher, so some bit of a positive cue coming in from the European markets as well this morning. But yes, that's all the overnight action that's happened on the global front. How is all that going to be impacting our Indian markets? What are we watching out for today? Our team of research is here to set you up for trade, tell you which are the important stocks to watch out for, as well as the update in the world of F&O. Hormaz, good morning. And today, are we expecting some green on the screen for the Indian markets, and will it sustain? That's the question, right?
Morning, Winnie. And the bulls would definitely be hoping for that. They've seen enough red all through the last 5 months, so definitely be hoping for some green, particularly going into the Holy Weekend. But over the last 2 days, it's been one common trend. We open lower, make a low, and then we recover from those levels. We recovered almost 250 points on Tuesday. We recovered another 150 yesterday. But unlike Tuesday, we did not end at the highs of the day. We ended slightly lower from those levels. But it was a choppy session nonetheless. But the good part was that we managed to defend that 22,450 level yet again. And what led that recovery? Of course, it was banking names, of course, like HDFC Bank and Kotak Bank. The one that dragged the index down was IT, and it was only IT that kept the index, the gains in check, or any potential recovery in check. But will the IT index rebound today? Possibly, because even Nasdaq rebounded last night from extremely oversold levels. We might see some similar action here today as well. And there's some positives for the market as well. The CPI falling to a 7-month low, IIP also coming in above expectations, so that's a positive. 22,450 of course remains the important level because we haven't closed below that for the last 5 trading sessions. We've been defending it intraday, and hopefully that happens today as well. The Nifty Bank too, led by HDFC Bank, we mentioned 47,840 as an important support yesterday. It rebounded from exactly those levels and closed above the mark of 48. Indicent also saw a bounce yesterday, but of course the stock is in the F&O band, so you have to keep an eye out on that as well. And for that immediate range for the Nifty Bank remains between that 47,840 to 48,500 range. Today, of course, the weekly expiry going into the long weekend might remain light on position, so expect some consolidation. But for now, it is the GIFT Nifty indicating a positive start. Hopefully, that sustains going into the holy day as well.
Absolutely, Horbaz. And just, highlighting that it's gone 15 points higher as well. When we started the show, it was around 30 now. It's 45 points higher than Nifty implied open. So hoping for much higher start coming in for the Indian markets. Let's hope for the best. But let's go across to Abhishek, who's here to tell us which are the important stocks to watch out for in today's trading session. Good morning, Abhishek.
Good morning, Vinny. So to begin with, Bharat Electronics, they have backed an order of about 2,463 crore for Ashwini Radars from Indian Air Force. So NTPC Green, they have commissioned the second part of their 50 megawatt of 105 megawatt Sajapur Solar Project Unit 1 of their arm. First source, their arm in USA has incorporated an arm in Colombia as well. Now, NHPC will consider their borrowing plan for FY26 on March 19. Jubilant Pharmova, over there, the US FDA has issued establishment inspection report with, voluntary action indicated for their arm Jubilant Cadista, Maryland-based solid oral formulation facility. Jayaprakash Associate, they have assigned their outstanding debt to NARCL. Zydus Life, Zynext Ventures, they will invest in Elixir, to advance their novel oral therapy for sickle cell disease. Coromandel International, the board has approved acquisition of 53.1% stake in NACL for a consideration close to rupees 820 crore. Ola Electric, they have announced a holy flash sale offer for their S1 range e-scooters. So they will provide discounts of up to 26,750 on S1 Air and 22,000 on S1 X Plus Gen 2. They will also offer discount of up to 25,000 on the rest of S1 range, including the S1 Gen 3 range, and also additional discount that they will offer, or the benefits of up to 10,500 rupees is there for customers. Back to you.
Okay, Abhishek, thank you so much for that. But let's get you the final update on the domestic front. What are the important cues to watch out for in the world of F&O today? We have Sudarshan who's here to give us that update. Good morning, Sudarshan.
Good morning, Vinny. So for the second straight day, we saw similar pattern playing out. We saw market opening with cuts, seeing intraday recovery, and at the end closing near day's high. For today, GIFT Nifty is indicating a start with minor gains. Talking about the flows, yesterday also we saw FIs selling shares in the cash market. Sell number was more than rupees 1,600 crore, while for DIs, buy number was more than rupees 1,500 crore. In the index futures, two FIs have sold more than 800 crore. Even the index options, we saw selling of around rupees 8,100 crore. Only in the stock futures, FIs have bought nearly 600 crore. Also, they have reduced long positions by 700 contracts and have had short positions by more than 3,800 contracts. With this, FI's long exposure now stands at 18%. On the option front, on the call side, 22,550 and 22,660 call options were active and seen healthy additions. And on the put side, 22,300 and 22,350 put options have seen healthy additions. With this, support for Nifty remains around 22,300 and resistance at 22,800. But on immediate basis, resistance is at 22,620. That is also 20-day moving average. With the stocks in the band are IndusInd Bank, SAIL, BSE, Hind Copper and Manappuram.
Okay, Sudarshan, thank you so much for that. But on that note, let's just step into a very short break, viewers. And after the break, we'll get to the highlights from the February CPI data as well as the January IIP data that was released last evening. Welcome back to Power Breakfast on CNBC TV 18. Let's move on to some macro data points. Retail inflation has eased to a 7-month low in February. Largely, that was led by the fall in food prices. Now, this has paved the way for a RBI repo rate cut next month. Meanwhile, the industrial output has grown by 5% in the month of January. Let's go across to Lata Venkatesh, who's joining you with us to decode these numbers for us. Lata, good morning and take it away.
Yes, the inflation number is lower than what the CNBC TV 18 poll indicated. Ours was 3.85 and it's coming at 3.61. But 3.61 is way lower than the MPC's mandate, which is to keep inflation at 4%. So this clearly indicates that there is a scope for more rate cuts. The other important point is the Reserve Bank's forecast for Jan, Feb, March is an average inflation of 4.4%. Now with Jan and Feb, the average is working out to 3.85, and the March inflation is expected to be around 4%. So the average will be way lower than what the RBI is forecasting. Instead of 4.4, we may end up south of 4% for this quarter, which also gives reason to believe that an April rate cut is very much on the cards. The other positive from the inflation number is, of course, the food inflation number coming in at 3.75%. The CNBC TV18 poll indicated 4%. And January inflation was 6.02. For the previous 18 months, we have been between 8 and 11%. So at 3.75, this is, a multi-year low in terms of food inflation. Economists tell us now that for the next couple of years, we should not be worrying because food inflation normally follows a cycle. That will mean more rate cuts as well. So these are the positives that are coming in from the inflation number. The other positive is, of course, the IIP number coming in better than expected at 5%. The internals are even more impressive because manufacturing has come in at 5.5% for the month of January. If you take the April or January number, it is 4.2, which means January is so much better than the previous month average, which gives hope that perhaps we are going to get a slightly better growth rate for even the GDP for Jan, Feb, March, as and when it's announced. The only negative over there is that the February auto sales numbers were not as impressive. But sticking to the Jan IIP, we also have very good numbers coming in for CapEx. Capital goods is at 7.8%. It was 10.4 in December. So again, that shows that CapEx is on a strong footing. Infrastructure is at 7%. Intermediate goods at 5.2%. And consumer durables is at 7.2%. So almost all verticals of consumption and investment seem to be going very good, even on the growth front. Only consumer non-durables has not done very well. But if food inflation continues to fall, then there's a little more available for consumption. So we should see consumer non-durables also picking up. All told, this is a great double delight number. Growth higher than expected, inflation lower than expected. We should see markets reacting positively.
Thank you so much for that. We're hoping for markets reacting positively to both these data points as well. But on to CNBC TV18 exclusive. The government is keen that GST rate rationalization be based on principle of reducing the tax burden and not only on revenue augmentation. Sources have told CNBC TV18 that the government is not in favor of recommendations like a new 35% slab or price-based rates by the GOM on rates. Tim C is joining in with us to give us these details. Tim C, what are your sources picking up and telling you on this front?
With now all eyes on GST rate rationalization to ease the tax burden on common man, sources are indicating to CNBC TV18 that the government is not in favor of introducing a new slab of a special rate of 35% as proposed by the GOM on GST rates. The government is also not in favor of GOM's proposal to have separate rates for items based on prices, as it believes that this could make compliance more complex. However, sources indicated that when it comes to the proposal of the GOM to consider hiking rates on items not used so frequently, such as hair dryers, curlers, specific makeup kits, amongst others, the government is in favor of bringing such items back to 28% slab. On the other hand, when it comes to food items, the broad intent in the government is to reducing the rates, and it is likely to propose to keep as many as commonly used items in the 5% slab. Sources also shared that the current rate rationalization exercise will be based on principles of reducing tax burden and not only on revenue augmentation. The government is also weighing in the option as to whether rationalization can go hand in hand with merger of slabs, along with keeping a focus on revenue neutrality, maintaining a fine balance of industry concerns, and not to have any negative impact or leading to a reduction in state finances.
Thank you so much for that, Tim C. But on that note, we're going to slip into a very short break. Up next, we get you the cues from the world of commodities, so don't go anywhere. Welcome back to Power Breakfast on CNBC TV 18. Now time to go across to Manisha, who's waiting by to tell us what's happening in the world of commodities today. Manisha, good morning. Are we seeing some uptick in the commodity space? What are the metals doing? And crude prices as well?
Oh, well, absolutely. After that very sharp decline yesterday, today we've started on a very positive note. Well, overnight as well, you've seen the crude oil prices gain up by 2%. The U.S. data came in slightly supportive as well because you're looking at strong domestic demand and slightly slowing inflation. If the inflation was 0.5% in Jan, it was 0.2% in the month of Feb, and that clearly was supportive. Also, when you look at the crude oil prices, it is about gasoline inventories in U.S. declining by nearly 6 million barrels. That was supportive as well. But of course, the markets will watch out for the ongoing tariff war, the weak Chinese demand and data that continues to weigh on. In the metals as a sector as well, overnight trades were on the positive side. Copper prices gained up 1.5%. Silver was up 1.5% overnight. Zinc is now trading at a 2-month high. Lead prices at a 13-week highs, and aluminum and copper continue to hold around 9-month highs. Remember, the dollar index is also trading at a 5-month lows, and that in turn also is a supportive factor.
Okay, Manisha, thank you so much for that update in the world of commodities. A quick look at where the Nifty implied open is as of now. Seems like around a 50-55 point uptick is what the Nifty implied open is indicating. 60 points almost as of now. So has moved up gradually from when we started the show. Keep an eye out on where the Nifty will start the day. A bit of a positive start now is what it's looking like for the Nifty. With that, I'm going to wind down this edition of Power Breakfast on CNBC TV 18. Thank you so much for tuning in. Up next, your Bazaar Morning Call.